Imagine doubling, tripling, or even quadrupling your money over time. Sounds like a dream, right? But it's not. It's the power of investing. Investing, a word that is as intriguing as it is alluring. It's a journey, a game of strategy where the stakes are high and the rewards even higher. A world where the ordinary can become extraordinary, where small amounts of money can grow into fortunes, and where dreams can actually turn into reality. Yes, investing is about money, but it's also about something more. It's about patience, about understanding, about making informed decisions and standing by them. It's about taking risks, yes, but calculated ones. It's about the thrill of watching your money grow, of seeing your financial goals come closer within your reach. So, stick around as we delve into the world of investing, where dreams can and often do become reality. Before we proceed, it's important to note that I am not a licensed professional or a financial advisor. The insights and strategies shared in this video are purely for educational purposes. They are not intended to be taken as financial advice. Investing is not a game of luck, but a game of skill and knowledge. It's essential to understand that it carries inherent risks. Remember, investing involves risk. Make informed decisions and consider seeking advice from a certified professional. So, what exactly is investing? Well, in simplest terms, investing is about putting your money to work. Instead of letting it sit idly in a bank account, you use it to buy assets that you believe will increase in value over time. The goal? To make your money grow, to build wealth, and ultimately, to achieve financial freedom. Now, there are many ways to invest your money. Some people buy real estate, betting that property values will rise. Others start their own businesses, hoping to turn a profit. But for most of us, the world of investing revolves around financial assets like stocks, bonds, and mutual funds. Let's break these down. Stocks represent ownership in a company. When you buy a stock, you're buying a piece of that company. You become a shareholder, and as the company grows and becomes more profitable, the value of your stock increases. Bonds, on the other hand, are essentially loans. When you buy a bond, you're lending money to a government or a corporation. In return, they promise to pay you back with interest. Bonds are often considered safer than stocks, but the potential for profit is usually lower. Then there are mutual funds. These are investment vehicles that pool money from many investors to buy a diversified portfolio of stocks, bonds, or other assets. Mutual funds offer an easy way for average folks to get access to professionally managed, diversified portfolios. But remember, all investments come with risks. There's no guarantee that a stock will rise in price, that a bond issuer will repay its debt, or that a mutual fund will achieve its objectives. That's why it's crucial to do your homework and understand what you're investing in. Investing is not a get-rich-quick scheme. It's a long-term strategy. It's about patience, discipline, and making informed decisions. It's about understanding the market, assessing risks, and most importantly, staying committed to your financial goals. Investing is about making your money work for you. It's the key to financial freedom and wealth creation. So, are you ready to start your investing journey? Now that we know what investing is, how does it work? Let's dive right into the mechanics of investing. Think of the stock market as a bustling marketplace, but instead of fruits, vegetables, or clothes, people are buying and selling shares, pieces of ownership in a company. When you buy shares of a company, you become a partial owner of that company, no matter how small your share may be. Now, why would you want to own a piece of a company? Well, there are two primary ways you can make money from owning shares: dividends and capital gains. Dividends are a portion of a company's profits that are distributed to shareholders. Not all companies issue dividends, but those that do typically distribute them on a regular basis, often quarterly. So if you own shares in a company that issues dividends, you'll receive a certain amount of money for each share you own every time the company distributes dividends. On the other hand, capital gains are the increase in value of your shares over time. If you buy a share at $10 and it goes up to $15, you've made a capital gain of $5. But remember, the value of shares can also decrease. If that same share falls to $7, you'd have a capital loss of $3 if you decide to sell. Investing isn't just about buying and selling at the right time, though. It's about understanding the companies you're investing in, studying market trends, and making informed decisions based on that knowledge. And importantly, it's about patience. The stock market fluctuates day by day, but the most successful investors are those who are in it for the long haul. So there you have it, the stock market, shares, dividends, and capital gains. These are the gears and cogs that make the machinery of investing work. Just remember, every investor started out knowing nothing. Understanding these concepts is the first step towards becoming an informed investor. Ever heard of the term compound interest? It's often referred to as the eighth wonder of the world. Let's break it down. Compound interest is the interest you earn on both your original money and on the interest you continually accumulate. It's like a snowball rolling down a hill, growing bigger and faster with every roll. Picture this. You've decided to invest $1,000 at an annual interest rate of 5%. After 1 year, you've earned $50 in interest, bringing your total to $1,050. Now here's where the magic happens. In the second year, you're not just earning interest on your initial $1,000, but also on that extra $50 you made in the first year. So instead of earning another $50, you're earning $52.50. It might not seem like much of a difference now, but over time, this addition can significantly boost your total returns. This is the power of compound interest in action. Now let's take it up a notch. Imagine you leave that money untouched for 20 years. With simple interest, you'd have $1,500. But with compound interest, you'd have more than $2,600. That's over $1,000 more, just by letting your money work for you. This is why compound interest is such a significant concept in investing. It's about more than just making money. It's about making your money make more money. It's about leveraging time and patience to maximize wealth creation. And the best part, the longer you leave your money, the greater the compounding effect. This is why it's so crucial to start investing as early as possible. Even small amounts can grow into substantial sums over time thanks to the power of compounding. That's right, with compound interest, your money doesn't just grow, it multiplies. Investing is not without its risks, but it also comes with potential rewards. This is an undeniable truth of the financial world. The balance between risk and reward is a delicate dance, one that every investor must learn to navigate. When we talk about risks in investing, we're talking about the chance that things won't go as planned, that the investment you made in that promising startup won't yield the returns you anticipated, or that the stock market will take a downturn just when you need to pull out your funds. These are the realities of investing, and they cannot be ignored. But let's flip the coin and look at the other side. The rewards of investing can be significant. The potential to grow your wealth, to build a nest egg for the future, or even to attain financial freedom. These are the rewards that make investing such an enticing prospect. So, how do we balance these two? How do we mitigate the risks while maximizing the rewards? The answer lies in diversification. Diversification is the practice of spreading your investments across various sectors, asset classes, and geographical regions. Think of it as not putting all your eggs in one basket. By diversifying your portfolio, you can reduce the impact of any single investment going south. If one sector of the economy takes a hit, you're not left high and dry because your investments are spread out across other sectors that might be performing well. Now, it's important to note that diversification is not a guarantee against loss. It's a strategy to manage risk, not eliminate it. But by spreading your investments, you're less likely to suffer a catastrophic loss if one investment doesn't pan out. Remember, investing is a long-term game. There will be ups and downs, but over time, the potential for reward can outweigh the risks. A diversified portfolio can help you weather the storms and come out on the other side with your financial goals intact. Reward without risk is a myth in investing. The key is to manage the risk. And with the right strategies in place, you can do just that. So let's continue this journey of investing armed with a deeper understanding of the risks and rewards involved. Investing is not a get-rich-quick scheme, it's a long game. We've all heard the old adage, patience is a virtue, and it couldn't be more relevant when it comes to investing. It's not about making a quick buck today, but about growing your wealth over time. So, why is patience so critical in investing? Well, the answer lies in the power of Compound interest. The longer you keep your money invested, the more time it has to grow. In other words, your money makes money on its own, and then that money makes even more money. It's like a snowball rolling down a hill, gaining size and momentum as it goes. Now let's talk about consistency. Consistency in investing is all about making regular contributions to your investment portfolio, regardless of market conditions. It means investing a fixed amount at regular intervals, also known as dollar cost averaging. This strategy allows you to buy more shares when prices are low and fewer when prices are high, resulting in a lower average cost per share over time. But why is this important? Well, it's because the market is unpredictable. Prices rise and fall often due to factors beyond our control. By investing consistently, you're not trying to time the market or predict its movements. Instead, you're focusing on what you can control: how much you invest and how often. So how does this all tie into wealth creation? Well, long-term investing coupled with patience and consistency allows you to take advantage of the power of compound interest and the benefits of dollar cost averaging. Over time, these factors can result in significant wealth creation. Yes, there will be ups and downs. Yes, it may take years, even decades, to see substantial growth. But remember, the goal here is not to get rich quick, but to build wealth over time. And so, as we wrap up this discussion, let's revisit our initial statement. Investing is not a get-rich-quick scheme. It's a long game. A game that requires patience, consistency, and a long-term perspective. Remember, Rome wasn't built in a day, and neither is wealth. So, are you ready to embark on your investing journey? We've covered a lot of ground today. Let's take a moment to recap the key points. We started off by discussing the power of investing, the magic it holds in building wealth, and how it can unlock doors to financial freedom. It's not just about making money, but about making your money work for you. We then addressed the elephant in the room: risk. Yes, investing comes with its own set of risks. But as we've discussed, understanding these risks and learning how to navigate them can lead to rewards that far outweigh the initial fear. We delved into the mechanics of investing, the nuts and bolts that make the machine work. We looked at the different types of investments and how they each play a role in a well-rounded portfolio. And let's not forget about the power of compound interest. Remember, it's not just about the initial investment, but about the interest on the interest. Finally, we explored long-term investing and the role it plays in wealth creation. It's not about getting rich quick, it's about consistent growth over time. If you found this video helpful, please hit that like button, subscribe to our channel, and share this video with others. Remember, knowledge is power, and sharing it can empower others.